Breaking news out of Wall Street tonight, and if you're an Apple user who's been dreading your next iPhone upgrade, you might just want to keep watching, because this story could save you some serious cash. JPMorgan, one of the most powerful and influential financial institutions on the planet, has just dropped a bombshell analysis suggesting that the dreaded iPhone price hike that consumers and analysts alike have been bracing for may actually be significantly lower than anyone previously feared. And in today's economy, that is massive news. Let's break this down fast, because there's a lot happening here. For weeks, maybe even months, the financial world has been buzzing with anxiety over Apple's pricing strategy. With tariffs looming, supply chain pressures mounting, and the cost of manufacturing continuing to climb, Wall Street analysts had been painting a pretty grim picture for iPhone buyers. Some estimates were throwing around price increases that could have pushed flagship iPhone models into truly eye-watering territory. We're talking potential jumps that would have had consumers thinking twice before that next upgrade cycle. But here comes JPMorgan, riding in with an analysis that is turning those fears on their head. The banking giant is now suggesting that Apple may have far more flexibility in managing these cost pressures than the doom and gloom crowd had predicted. The key takeaway from JPMorgan's assessment is that Apple, with its legendary supply chain management and its extraordinary negotiating power with manufacturers and suppliers, may be able to absorb a significant portion of those additional costs without passing them all directly to the consumer. Now, why does this matter so enormously? Because Apple isn't just a tech company, it is a barometer for the entire consumer electronics industry. When Apple makes a pricing move, every competitor from Samsung to Google watches closely and responds accordingly. JPMorgan's revised outlook on Apple's pricing strategy has immediate and far-reaching implications not just for Apple on the NASDAQ, but for the entire smartphone market ecosystem. And let's talk about what this means for Apple's stock, because investors are paying very close attention right now. Shares of Apple, trading under the ticker Apple on the NASDAQ, have been navigating an incredibly turbulent period. Tariff uncertainty has created volatility across the entire tech sector, and Apple, given its deep manufacturing ties to China and its global supply chain complexity, has been right at the center of that storm. A signal from JPMorgan again, one of the most respected voices in global finance, that iPhone price increases may be more moderate than feared, is genuinely significant market-moving information. The theory JPMorgan appears to be working with is compelling. Apple's sheer scale gives it leverage that smaller companies simply don't have. Apple can negotiate, Apple can restructure, Apple can diversify, and historically, Apple has proven time and again that it can find ways to protect both its profit margins and its customer base simultaneously. It is a tightrope act that very few companies in history have managed to walk as skillfully as Apple does. For everyday consumers, this is the takeaway you need to hear: don't panic yet. If JPMorgan's analysis holds up, the next iPhone you buy might not require you to refinance your home after all. The price increases, while likely still present in some form, may land in a range that feels far more manageable than what many feared just weeks ago. For investors, this is a signal worth watching extremely carefully as earnings season approaches and as Apple's executive team prepares to address these very questions directly with shareholders. The bottom line tonight: Apple's pricing power in the face of economic headwinds might be the most underestimated force in all of consumer technology. And the real question now is not how much more you'll pay for your next iPhone, but rather how Apple continues to defy every expectation the market throws at it.